Hello and welcome to another AIM Research video podcast. As always, I'm here with Eric Basmajian with EPB Macro. Eric, it's always good to talk to you, man. How's things been going?
Good. Likewise, Grant. There's been a couple of changes since the last time we spoke, so it's going to be good to catch up.
I know you and I have probably been receiving a lot of questions with inflation sticking, Russia invading Ukraine, and we're going to get, I think this one's going to be a fun one for not only you and I, but also for our listeners out there. So why don't I take a second, again, set the lay of the land for everyone.
Sure.
And then I'm going to flip it back to you and ask you what's changed. So
Okay, cool.
Let me start by sharing my screen real quick. Can you see this PowerPoint slide? So just to review the first quarter, at least the way that I saw it and experienced it, we saw growth slow down while inflation continued to stick. And so I really consider this as an inflationary gap that had been building first and foremost by everything remaining above trend. So just to take a second here, we had US real GDP above trend. We had non-farm payrolls above trend. We had consumption above trend. And then we also had industrial production above trend. And all of that was due to the massive amounts of stimulus that was provided, not only to business owners, but also consumers and individuals as well. So what was interesting, though, is you and I and many others saw inflation peaking and rolling over into the new year. But hardly any of us knew that Russia was going to cross the border of Ukraine and give us another supply chain shock. And oh, by the way, a zero COVID policy out of China, right? So I think that is, at least from my perspective, one of the main differences. And now we're having to deal with inflation sticking a little bit longer. Let me ask you, Eric, what has changed? What are you seeing after seeing that lay of the land?
Sure. If you can, while I set this up, just enable my screen sharing.
Mm-hmm.
I saw things, very much the same as you, in that growth was continuing to slow down, and my view was that we were going to see a peak in the inflation rate. Are you able to see this slide here?
Yep.
So this is, I show this chart when I come on. This is my coincident index of real growth, which is a composite of income, consumption, production, and employment. And this is only updated as of mostly February data, but you can see that the growth rate is still continuing to march lower. But this doesn't include data for March, which is going to push this number significantly lower because March is the month that we got this biggest inflation spike, right? And if we go back to something like retail sales, this number is updated as of March, and this is in real terms. And you could see that the growth rate in something like consumption in real terms is converging pretty close to zero. A lot of this is because the inflation rate, as you mentioned, is sticking higher than expected. One of the points that I was making on the last couple of quarterlies that we did is that the notion that inflation was going to stick higher was a possibility. I didn't think it was going to happen. I think there was evidence that it was rolling over, but I noted that if inflation did stick higher, it wasn't going to magically print nominal growth. It was going to be at the expense of real growth.
Right.
Right. And I think that's what we're seeing now with something like real consumption falling close to zero. Real income growth is basically zero or negative. And what we're going to eventually see is this spill over into production and employment. But, the way that I see the world now is still very much in line with you, which is the growth rate is continuing to come down. The inflation rate is still accelerating. And the forecast going forward is that the real growth rate is going to continue declining. And we're going to be in a situation over the next several months, I believe, where the real growth rate is going to slip into the 1% range. And it's going to put the economy in a really vulnerable position in terms of recessionary probabilities. I don't think, I don't have sufficient evidence to say that we're going to have a recession by the summer, but I think that by the summer months, the conditions for a recession will be there, meaning that any shock that hits the system in the summer will probably trigger or could trigger a recession, given that the economy is going to be quite vulnerable by then. And by that, I mean, there's going to be negative real income growth. There's likely to be negative real consumption growth. And you're also going to have downward momentum in the housing sector because of this rise in interest rates and mortgage rates that we've seen. So when you have negative real income, negative real consumption, and downward momentum in the housing sector, you're really, really close to a recession. And any sort of ancillary shock would be the straw that breaks the camel's back. And that shock could be anything from another oil price spike. It could be the Federal Reserve tightening policy too aggressively. It could be, China invading Taiwan. It could be anything. The shock is by definition unknowable, but the important consideration in my framework is understanding when the economy is vulnerable to one of those recessionary shocks. And I think that by the summer months, those conditions will be there.
Yeah, no, absolutely. I think that's a great way to describe it, is understanding the vulnerability of the economy. And it's not much different than, if you want to flip the screen back to me, I'm going to flip over and show a couple more slides, but it's not much different than the outlook that we have on when the economy's gaps have closed: the output gap, the unemployment gap, the inflation gap. And then even as we just showed this above trend, when you have that much excess demand, or consuming, a greater share of the capacity of the economy, you're moving into late cycle environments. And to your point, one of the shoes that I think is going to drop next, if I can get my screen to flip over, you can see that?
Yep.
Okay, perfect. So is, just as you mentioned, real personal income.
Exactly.
So it's not negative, or it might be negative now as of the February or March report, but it is below trend now, which I think is really, really interesting. And that's going to filter into, like you mentioned, the consumption and the mortgage applications at some point. To flip over to like our growth estimate here that I put out, let me see here. I was seeing a pretty hard reduction coming into Q1. I mean, the lower end of the forecast, of course, is probably going to be the primary thing to look at here at 172. But even the second quarter, I'm showing an even further reduction at only about 0.5%. And if you do get that recessionary outlook, let's say inflation remains stubborn, because I think that's what ultimately will push us into recession. We can talk a little bit about the inflation here in a second. But on my lower end of the forecast, I've got minus 2.96, which I think that brings into your viewpoint there. So is that how you're looking at it? Does inflation have to remain stubborn to get the recession?
Yeah. I just want to show one chart here, because it's very similar to what you showed. This is my view on real personal income. I exclude transfer payments for one of my metrics. I do look at it, but for this chart, I take real personal income excluding transfer payments, and I look at the growth rate. And to your point, I just calculate the trend here as simply the 10-year average, and we're significantly below trend. Yeah. It's not quite negative yet, but what's important is that this data point's only updated as of February. It's not updated as of March because the number hasn't come out yet. March had extremely high inflation. So if I impute some of the estimates, this number is going to be 0.5 by the time the March number comes out. So it's going to be really close to a negative reading. I'm not sure if I have it in this slide deck here, or if it's in another one of my slide decks. But let me see here. I think I have it because I want to show this 4-panel view of what I believe is going on here. Okay, got it right here. So can you see these 4 charts here?
Coming in now. Yeah, you're good.
Okay, so these are the 4 factors that make up that coincident index that I showed. And what I'm trying to articulate here is you have to look at all 4 corners of the economy separately to see what's going on, but then as a composite, because that's what judges the whole economy. And what we could see here is that real income is what's pulling the cycle lower. Now, none of these are leading indicators. This doesn't tell you where it's going. This just kind of gives you an idea of how the cycle is playing out at the moment. And what we see is that real income on the bottom right here is declining pretty sharply. It's a declining trend noted by the red line, and it's getting close to zero. It's going to be 0.5% likely by the time the March number comes in. That real income is pulling down real consumption. Again, it's a declining trend noted by the red line. And this 3.2% number, again, is as of February. The retail sales number was down at 0.7. So real income is declining. It's pulling down real consumption, which is effectively unit volumes, right? And this is how the cycle moves, right? So that now that we're going to see real income is going to be declining, real consumption or unit volume is going to be declining, and we see industrial production is in a downward trend noted by the red line, but the last few months have been accelerating upwards. What I think is going to happen is, as a result of the decline in income, the decline in consumption, this is going to start to pull the production numbers down as well. And you can see that the only part of the economy that still has an accelerating trend is employment. But it's not a surprise to most people that follow these cycles, because we all know that employment is the most lagging of these four indicators, right? Mm-hmm. So what I think is going to happen here is this cycle, the way that the economy moves, is going to intensify in this downward spiral. We're going to see negative real income that's going to pull consumption into negative territory, or a contraction in unit volumes. As unit volumes contract, companies are going to realize that they have a lot of inventory, and they're going to scale back new orders. Then it's going to pull production down. And only once the production numbers start to come down are you going to see the employment numbers start to fall. So, when the Fed is staring at employment, that's why it's always so lagging. But that's the cyclical flow that I'm monitoring here, is how real income's feeding into consumption, which is feeding into production, and then how that ultimately is going to feed into employment.
That's perfect, because why are we measuring in real terms? It's because the inflation rate is so dramatic, right?
Right. And importantly, sorry, just to jump in 1 second, is a lot of people push back on my focus on real numbers. But real numbers or unit volumes are what drives the economy, mm-hmm. right? If you think about like a factory, if you sell 10 cars at $1 for $10 of output, there's a lot of people that you need to produce those 10 cars, right? That's 10 people of employment, or whatever the case may be. If you have high inflation and collapsing real growth to the point where you now sell one car at $10, it's the same nominal $10 output, but you got a lot of excess capacity now. You're only producing one car in that factory. You don't need those 9 other employees anymore, right? Mm-hmm. So it's really unit volumes that move the economic engine. And that's why I focus on real numbers. I mean, of course, I focus on the inflation rate as well. But as far as the cyclical impulse in the economy, I really believe that it's unit volumes that drive the engine.
Nope, that I couldn't agree more. And that's a big reason why I wanted to get to the heart of, what could drag us into that recession. And that feedback loop that you mentioned is the best way to describe it. You're getting the dominoes to start to fall, but there's still a couple that remain somewhat elevated, such as industrial production and non-farm payrolls. And again, going back to most of the economy, when you're looking at it on a trend perspective, is still well above trend, and you're just now seeing the income take a hit. Mm-hmm. And I think that leads us perfectly into the inflation conversation, because my viewpoint, and I think I've mentioned it once already, is the speed at which inflation comes down is going to be the most important thing that investors, strategists, money, asset allocators need to be focused on. Because if it remains stubborn, then I believe that's what's going to ultimately tip you potentially into the recession category. Mm-hmm. It's whether or not it can come down quick enough. So I want to, again, show you a couple of charts here, and let's talk a little bit about inflation and maybe hit on how the Fed is going to be fighting this. So I'm going to back up a little bit here. Coming into Q1, I had my inflation gap model coming in at 5.3 for Q1. So add 2% for the target, 7.3. And even on the upper forecast, 7.85 for Q1. So of course, with Russia invading Ukraine, we've blown through that upper forecast. Mm-hmm. And the big thing about this forecast, though, was how quickly it was rolling over.
Right.
Right. It was a big reason why, our output gap was showing a slowdown in Q1, but a reacceleration throughout the rest of the year.
Mm-hmm.
Well, now we've got to throw that out, and we've got to say, okay, now that inflation is continuing to stick, what does that look like going forward? So, rerunning the estimates before we get Q1 data, which comes out here in next week, is it the 28th, I believe. We're seeing how the inflation, at least through the summer, could potentially still have a 7 number in front of it. And if it does continue to blow out to the upside, you could see roughly 9.5 by June. Mm-hmm. Even on the lower forecast, you still only have 5.7. So I would consider that very much stubborn. I think the only bright part, at least from what I'm seeing, is inflation expectations somehow are well anchored.
Right.
So what do you think about that, in the fact that inflation expectations are not yet picking up on the 2-year going forward, but yet the here and now very much is the inflation struggle that we're dealing with here?
Yeah, I think that the inflation expectations are, in my view, rightfully, or at least the long-term inflation expectations. Like, I like the 5-year forward inflation expectations because it's really kind of that longer part of the 10-year forecast. And I think that rightfully it's not rising too far out of the range that the Fed likes, because at the moment, the Fed, believe it or not, still has credibility with the bond market, right? May not have credibility with average people, but it's got credibility with the bond market.
Right.
And what the Federal Reserve is saying that they're going to do is they're going to hike interest rates above neutral. They've explicitly said that they want to get the rate above neutral. And almost definitionally, that means a recession, right? If they're going to raise interest rates above the level that facilitates max employment, that means they're going to raise interest rates effectively until there's job losses. Mm-hmm. Well, that's a very disinflationary or deflationary environment. So I think that the short-term inflation expectations, like if you look at maybe 5-year break-evens or even shorter, they're rising quite substantially. They tend to track commodity prices pretty closely. But I think that the longer run inflation expectations are really sort of watching carefully to the fact that, hey, look, if they're really going to raise interest rates above neutral or to 3% or 3.5%, like what's priced in, there's going to be a pretty wicked disinflationary scenario on the backside of this. The other point that I want to show is this is my kind of panel on inflation here, which shows, I assume that your numbers were year over year.
Mm-hmm. Yes, that's right.
My numbers here are 6-month annualized growth rate, which is why I have a 9 handle already on mm-hmm. my black line is headline CPI. But what I think is interesting to note here is the divergence or gap that developed in the last report as a result of core and headline, right? Headline accelerated 120 basis points month on month, and core decelerated to actually a 4-month low, right? How did that happen? It was mainly because of the used cars, right? We're starting to see a decline in used car prices. And this goes very much in line with that cyclical phenomenon that I was describing earlier, with decline in real income is pushing down unit volume of real consumption. And that's going to eventually make the inventory numbers for some of these durable goods seem excessive. And you may start to see price cuts. Well, that's going to feed through the core numbers a lot more than the headline numbers, because they take out food and fuel. And if food and fuel are the two components that are rising most substantially as a result of the Russia and Ukraine invasion, we could see a scenario, I think, through the summer months where the core numbers are rising based on food and fuel, where the headline numbers, where the core numbers are starting to kind of crest and come down a little bit because of some of the durable goods that are going to be in plentiful supply, I think, once the consumer really starts to pull back.
Wow, that's a great observation, because it's got my wheels turning so much, because now I'm like, does the Fed hide behind the headline number? Despite
they say that they like core, right? They say that they like core.
They even model everything on core. So right. It would be interesting to watch core roll over and headline sticking.
Because what's so interesting is that, and this is, I wrote a note, obviously 6 months premature at this point about why, it was the title was why you shouldn't be worried about rent inflation, right? But this was probably 8 or 9 months ago before, commodity price spikes and things like that. But my main point of the article was everyone says that rent inflation is going up and it's 33% of the CPI. My point, which was obviously 8 months early, was that it's not just the size of the component that matters, it's the volatility of the component, right? So the durable goods component is only 10% of the basket. But the volatility of the durable goods is massive, right? And that's what's driven the rise in a lot of the headline indices. You have 25% inflation in the durable goods sector. The durable goods sector has spent the last 15 years in deflation, right? So just by nature, if the durable goods sector returns to his historical trend, you're going to have the year-over-year rate of durables go from 25 to 0, right? At a 10% weighting, that's going to take 2.5 points off the CPI reading. Most of that's going to come off core, right? So there's a huge component of durables that are really going to swing this, even though commodity prices may still be high.
And it should make sense, right? Because what are durable goods? Like, just to reiterate this for our listeners, it's the things that when you buy them, they tend to last for a few years.
Right.
Like you're likely not going to buy them again for a little bit.
Right. It's the concept of pent up demand, right? We had this unbelievable, and this is maybe, not to hijack the conversation and move it into a different direction, but I think that this is important for people to realize, because this is, it was underappreciated by myself for sure. Can you see this chart here?
No, keep going. Try to share it again.
Okay. What I'm showing here is the cyclical component of GDP, or what I call the cyclical component of GDP. It's housing and durable goods, right? Can you see this?
Yep. Mm-hmm.
Okay, so what this shows is that before COVID, housing and durable goods was running at 11% of GDP. And it was the lowest level that we'd seen in decades as a result of massive overinvestment in housing in the 2005 cycle. And we absolutely crushed the housing and durable goods, and it started to come back a little bit, and then it was declining. It was 11%. As a result of fiscal stimulus, but in my view, more so than the stimulus, there was a behavioral aspect to the shift. We increased the amount of GDP that was coming from housing and durable goods from 11% to 14%, basically overnight, right? And what's important about this chart is not the level. We've been at 14% many times before, but it's the spike. It was the fastest explosion in housing and durable goods that the country's ever seen. The housing and durable goods sector was growing at a 35% annualized growth rate. That's what blew out supply chains, right? But on the flip side of this, what this means is that everybody that wanted to moved. Everyone that wanted to redo their house redid their house, right? Everyone that bought durable goods is not going to need to buy those durable goods again, right? So what was the explosion about? It was about moving from cities to suburbs. It was about refurnishing a home office because you couldn't go to the office. You needed to buy desks, chairs, computer equipment. You were spending more time at home, so maybe you wanted to upgrade appliances, right? And as you mentioned, these are all things that you don't consume every 2 or 3 years. Mm-hmm. These have a 5 to 7 year cycle to them, right? You buy a refrigerator, you're not going to need another one every 2 years. So what we did was we cranked the housing and durable goods sector so hard and so fast, it destroyed supply chains, but there's still, and I know that we have been saying this for a couple of months now, there's still going to be this unbelievable hangover in the durable goods sector of everybody already consumed all of the durable goods that they need.
Yeah.
They're not going to need them again. You're not going to need another oven after you already bought it.
And that should, to your point, that should start to bring down the rate of inflation. And why we kept saying that a lot of the major components of inflation were looking a little sluggish there in the late half of the year. And if it wasn't for Russia invading Ukraine, we wouldn't be getting this second wind of inflation. So
yeah, exactly. And I think that chart of core versus headline sort of tells the tale. The core numbers did roll over.
yeah,
Right. It was the headline that spiked, and what drives headline? It's food and fuel. And those were the two big factors from Russia, Ukraine, right? The wheat prices and the oil prices.
yeah, you could probably just look at like oil from here on out to get your headline number right.
Exactly.
So that's a great point. And I'm going to circle you back to the Fed, because with them trying to track inflation, that's enemy number one, and it's going to continue to be enemy number one probably until the midterms, unless we get that feedback loop that you're talking about and we start to see some job losses, right? I've been spending a lot of time, especially because our calls have long dated treasuries in the portfolios that have been built in there. And so I've been spending a lot of time on the terminal rate, where the Fed might actually stop raising interest rates, or where interest rates in the bond market in general might top out. And I want to see what you think about this, because it sounds like our base cases are very similar, and maybe we should elaborate the base case just a little bit more. My base case is that growth is going to continue to slow down. Inflation is going to slow down, but I believe it's going to be sticky, which is what's going to give the Fed credibility to continue to fight it here. And it's only sticky because of the supply chain shocks from Russia and Ukraine and from the zero COVID policy. But I want to show you a couple of charts here to see what you think, and then kind of get your take here. So the first chart that you're seeing is a little busy. It's got the 2-year treasury rate in this light blue here. It's got the upper and the lower bound of the federal funds rate, or the target range that they're trying to hit. It's got the green line, which is the actual federal funds rate as they're raising it. And then the 1-month treasury, which tends to fit right in that target range.
Yep.
So the 2-year, of course, being where the market believes the interest rates are going to go, which is roughly around that 2.5. I have a little different viewpoint, and I want to hit on that. My viewpoint comes at understanding what that natural rate is, and you hit on it, that there are some Fed officials believing that that natural rate is 2.5%, or roughly 2% if you ask some of them. The Taylor rule, even John Taylor mentioned it at 2%. So what you're seeing here is the Fed funds rate in orange or red there, a modified Taylor rule, and I'll let you know what our neutral rate is in just a second, versus the actual Taylor rule. If we take the Taylor rule at its word, or at its equation, you've got a 2% inflation rate. I'm sorry, a 2% neutral rate. You've got an 8% inflation rate. I'm paraphrasing there for a second. 0.5% times the gap of inflation, which is 8 minus 2 is 6. And then 0.5% times the output gap, which is still roughly negative. It's minus 0.5 or so. That gives Taylor's rate at just a touch over 10%. If we modify the Taylor rule, and when I say modify, there are a couple other ways to actually go in and create an estimate for the neutral rule. Bullard, in fact, believed that it was the 1-year treasury minus the inflation rate. You're seeing that there in yellow on the chart. You can also see where that's deeply negative. That's almost a minus 7%. If we plug that in, you can see, if we kind of reverse math a little bit and do some algebra, Taylor's rule is not too far from that. If you isolate the neutral component of that algebra there, our estimate is in that blue kind of smoothed HP index, which is currently minus 3. So my argument is they want the Fed funds rate to be at least 3%. So this neutral rate is back to 0. And in the process of doing that, I think that what is potentially what could blow up either the equity market or the credit market, because you're going to invert the yield curve, right? Go down a little bit further here to our yield curve estimate. You're going to invert the yield curve even further and potentially throw us into a recession. What are your thoughts there?
Yeah, I'm very much on the same page, and I think what's priced into the way that I get the estimates of Fed rate hikes is looking at the euro dollar futures curve. And I think that what's priced into the euro dollar futures curve is very much in line with what you said and what the Fed wants to do, right? They think that they want to hike rates to maybe the 2.5% point, or they believe that that's the neutral rate. And the euro dollar futures curve at the moment is pricing in Fed funds rate of about 3% by the summer of 2023, which would be in line with some of the guidance from these Fed governors that say they want to go slightly above neutral, right? So they may believe that 2.5 is the neutral rate, and they want to maybe try and go to 3. And I think that's why we're starting to see the curve invert in a lot of spots and re-invert, right? We saw like 5s versus 30s invert. It came out of inversion. And on Powell's reiteration of some of his hawkish commentary today, it re-inverted again. So I'm very much in the same page as you. I still am. I still don't believe that they're going to be able to complete the full hiking cycle that's baked into the euro dollar curve, or 2.5%, whatever you want to get to. I don't think they're going to be able to get to that level without recessionary conditions becoming extremely obvious. And that either means, job losses in the economic data, or just really disorderly equity and credit markets.
So they're going to have to move quick. Like, let's be honest, like, unless they start to do some intermediate term rate hikes, they're not going to get there.
Yeah. Because time is not on their side, because of, when we have to understand how economic data flows in the sequence, right? In my framework, those 4 corners of the economy that I showed you, those are coincident indicators, right? Those are sort of at the end of the sequence, right? That's sort of what's happening today. But then you have shorter leading data and you have longer leading data. The gap between longer leading data and coincident data, it varies. It could be anywhere between 12 to 18 months, right? So when you look at something like, okay, what's a longer leading indicator? A longer leading indicator could be the rate of change in private borrowing rates, like mortgage rates and corporate rates. So if you're just jumping, what I mean by that is you have a crazy spike in mortgage and corporate rates, which we have had. 12 to 18 months later is when you would see a deterioration in coincident economic data like employment, consumption, income, production, things like that, right? And I'm making this overly reductionist.
No,
but my point here is that the rise in interest rates and mortgage rates is already baked in, right? That's already going to flow through the economic data at some point in the future. And I say 12 to 18 months is sort of the historical time, but this cycle is moving faster than other cycles. And also the speed of the move has been the fastest ever. So that would, in my mind, pull forward that window or that lead lag time between long leading and coincident data. So let's just be generous and say it's 12 months or 8 to 12 months.
Mm-hmm.
That puts us at the end of 2022 or the beginning of 2023 for those, quote unquote, recessionary conditions to be obvious based on the current spike in interest rates. But the Fed funds futures market isn't pricing in the peak in the Fed funds rate until June of 2023.
Yeah.
Point is, they're not going to make it to June of 2023.
Right.
Because what happened with mortgage rates today is going to impact the economy way before June 2023.
The market has truly pushed you there already.
Exactly.
And that's why the Fed should come out, and they're debating 50 basis points. They should come out and just say 1% or 1.5%.
They've created an environment where there's the market has fully priced in their hiking path, but they're saying they're not going to realize that whole path for about a year and a half, But the problem is the magnitude of the pricing that happened today is going to cause massive economic deterioration before they're done with that, before they're done realizing that path that they're pricing in.
So do the paths cross? Do you see a situation where the market starts bringing rates down while the Fed's still raising rates?
I do.
Yeah.
I do. And I think that happens when the recessionary conditions, let me phrase it differently. I think that happens when consensus believes the probability of a hard landing is significantly outweighs that of a soft landing.
Yeah.
In my view, as I stand here today, I would say that the probability of a hard landing is greater than a soft landing, but I don't think that's what's priced into markets, or I don't believe that that's the consensus opinion. I think that while people may say that a soft landing is unlikely, I think that if you just look at credit spreads like triple B OAS spreads at 160 basis points, that's the judge right there. That's not a hard landing.
Yeah.
Right.
Right. Yeah. No, I completely agree. I mean, that's a really great point, because it is going to fall on the yield curve then at that point. I mean, that could be your second indicator to watch. So not only are you watching inflation to break, but you're watching that cross section, right, where the Fed keeps raising, but the long end starts to come down. And
this chart that you have here is awesome, because the yield curve right now is only mildly inverted or flat. But because their policy is so far behind expectations, it's a little bit hard for many people to pull up. But if you're able to get a chart of something like the 2s, 10s 1 year forward curve, it looks exactly like your chart, meaning that the market's saying the 2s, 10s spread 1 year from today is going to be like minus 70 basis points, like massively inverted.
Yeah. Yeah. But we also have to think about the impact that's going to have on the market, right? Because you're going to have very safe assets. Let's say they're successful. Let's say they get to 3%. You're going to have a 1 month treasury, or potentially your money market funds, paying you 3%. At what point do people say, Facebook looks a little risky. They don't pay a 3% dividend. Right. Let me tuck my money over here for a little bit. Right? I mean, that's going to happen at some point, especially when a lot of your baby boomers are moving into that retirement phase and they're looking for fixed income.
Exactly.
Right?
Exactly.
And so one of the things that I've been looking at, and I think you hit the nail on the head, is I don't think the long end of the curve is going to move very much, because the long end is going to get pegged to growth, which is what you're seeing in this chart here. This is a chart going back to the 70s that's got annual growth rates of not only the GDP, but also the 30-year treasury rate. It's got a 0.62 correlation. And so what that tells you is the long end is pegged to what economic growth is actually going to be. And this spike in growth that we're seeing is truly an anomaly. When I like to look to estimate it by using things like the capital stock or the total factor productivity or the labor growth of the economy, we're coming in somewhere in the market of roughly 2.5%. And if you illustrate it in a different way, you're looking at a small production function here of the increasing level of employment and how much additional output that we're getting with that over time. And the slope of that curve is also showing about a 2% at 1.97 here. So the reason why I wanted to illustrate that is the fact that the long end, in my opinion, unless you do get a recession, is more than likely going to be pegged between 2 and 2.5%. And if you get a 3 on the Fed funds, there's your inversion from really the full curve, not just a 2s, 10s, from a 1 month to a 30-year.
Right. No, it's exactly what I have in my chart book. It's actually ironic. I have almost the exact same chart. I have here, going back to 1979, a 5-year annualized growth rate of nominal GDP and the 30-year treasury rate, to show that they really do move in lockstep. So, where nominal GDP goes, that's where the 30-year treasury will ultimately go. I think that the biggest question that I get when I present that chart, and I think that maybe you get this question too, so I'll pose it to you, is you extrapolated your estimate of 2 to 2.5% growth. I assume that's a real estimate of real growth.
Correct.
So how do you square where inflation sits on a long-term, on a 10, 20-year basis? Because that's what will, complete the nominal picture, which would give us our read on treasury. Because, you talk to some people that are very bullish on inflation. They say, well, yeah, real growth is going to be 2, but I still think inflation is going to stick at 4 for the next 10 years. So that means nominal is going to be 6.
Yeah. Well, the inflation expectations that I just showed you a few charts earlier, if I could go back to that, let me pull that back up. Let's assume it's right. Let me share that screen. Are we good? Got that?
Yep.
So you're seeing the red line and the black line down there in the gutter, basically. 5-year expectations are still anchored at 2%.
Mm-hmm. So this is 5-year expected inflation based on Cleveland Fed?
No, based on consumer expectations coming from the University of Michigan.
Okay, so all of these lines, except for the
personal consumption,
except for the goldish line, are from University of Michigan.
Yes.
Okay.
Yes. So 2%. Right. So these expectations, I think, are really interesting in that, yeah, you're right. Real GDP is not going to be much higher than what we're experiencing right now, maybe 4% in the long term. Mm-hmm. And that's I personally believe that's on the high end. Mm-hmm. Right. I
agree. I think that the long run trajectory of real GDP is going to be significantly lower than 2%.
I would imagine 4% would be, quote unquote, crushing it.
Yeah, exactly.
Okay. So to summarize kind of, again, the economic landscape, I think both of you and I are basically in the same camp, which is why I love talking to you, Eric, because I think we feed off of each other really well. We see growth continuing to struggle as inflation kind of strangles the economy here. And the only way you get relief is if you can break inflation, right? Mm-hmm. And it's the speed of which of that happens and how hawkish the Fed is going to be, which determines whether or not we can get through this or whether it's going to go ahead and throw us into this recession or not. Anything you want to add before we look at the market implications of that?
Yeah, I would just say that if I was to put my outlook on the economy in a nutshell, is that the growth rate is decelerating. And I believe that over the next 3 to 6 months, the deterioration in real growth is going to be significantly faster than what consensus currently believes. Mm-hmm. I think that the next 3 to 6 months, recession risk will be palpable.
Yeah. I can't say it any better than that, because the only world that I see that growth picks back up is if you get inflation returning hard to trend, and we don't have an environment where that's going to happen. Mm-hmm. So let's pivot then, and let's close our conversation on market implications. Mm-hmm. You and I have been very defensive coming into this market environment. Safe to say that we're going to remain that way. That's my interpretation. I'm going to show you a couple of charts here of what I see as market positioning at the end of March. I didn't apologize. I didn't update it for April here, but we'll let April close out before we update it here. So looking at a couple of things here. So looking at a risk reward chart, just simply looking at the standard deviation versus the mean return over a 90-day period. Basically, your best risk reward, again, in the top left corner would be like utilities, healthcare, real estate, materials, staples, trying to make a run up there. If we get into the equity side, you're looking at lower volatility, defensive dividend payers, value. That's still screaming defensive unless you're seeing something different than I am.
No, I'm seeing it exactly the same way. I mean, if I had to break down the way that I'm looking at markets, in the equity universe, I've been saying you have to be defensive. And defensive, positions that I currently have are utilities, staples, min vol, dividend and buyback, concentrating companies that have majority of their earnings coming from dividends and buybacks. I also have a position in a market neutral ETF that's basically long, low beta, short, high beta. Basically all the same thing, which is expressions of defensive parts of the equity market instead of the offensive parts of the equity market. And if you maybe want to pull those charts back up, I think, instead of looking at the parts that are performing well, it's also probably worth looking at the parts that are performing really poorly. And my assumption is that you probably have a lot of your deeper cyclicals or your momentum or your high risk parts of the market that are performing poorly. Given my outlook, and I assume given your outlook, you'd want to continue to avoid those sectors. And I think that those are going to continue to perform poorly. Yeah. Maybe try the other slide where it had maybe some of the style factors.
Do you see the sector? Or?
I see sector right here.
Okay, so you want to see style factors. Here you go. So
there you go. High beta emerging markets. You got IWM down there. That's exactly what I would expect.
Yeah. And to make this chart a little easier for viewers, if nobody's seen it before, if this is your average, you can really, and I'm going to draw a terrible line here. Mm-hmm. You can cut these out into quadrants, right? Yep. And really with these charts, you want something that's giving you above average return with the least amount of risk that you can get a hold of, right, which would naturally peg you anything into this top left quadrant. Mm-hmm. Mm-hmm. Anything down here in this bottom right quadrant, you're taking greater risk and not getting paid for it, essentially.
Exactly.
Yeah.
So I think that exactly right. So I think that as far as the equity market, I'd want to stick defensive. I'd want to avoid cyclicals and momentum and high risk. So to me, that's long utility staples, low vol, quality balance sheets. I mean, you name it. You know the drill. Moving over to the fixed income market, however, I have been a proponent of long treasury bonds, which has been a loser certainly over the last several months. But going forward in the fixed income universe, I still believe that you want to be allocated to treasury bonds over credit. I believe that when growth is slowing, spreads are going to widen. Spreads have widened slightly, not as much as I would have expected given the deterioration in growth, but they have directionally widened. I would think that spreads continue to widen and probably more aggressively over the next several months. I would think that you'd want to be in treasuries over credit. And I do believe, although I've been early on this, that there is going to be a big buying opportunity in the longer duration space as the recession odds get more intense. Now, maybe for your model, we'd want to wait for that TLT and EDV to kind of come back onto the screen from being off the page on the bottom right. But
if we waited though, because remember, we're looking at this 90-day period. So if we waited for them to come back up here, you've probably missed a move, right?
Right.
I think that's why, Eric, because I'm in those, you and I have had a very similar outlook, and I've been in the TLT, EDVs, and the IEFs of the world. And I think that's why I spent so much time trying to figure out where that terminal rate is. To help the audience, that we need to find the peaking of rates. So if you're in some of these investments, it gives you the opportunity to dollar cost average in them if we do see this recessionary outlook that you and I are thinking. Mm-hmm. I'm with you. We're not calling it yet, and it's primarily because we have to understand the speed at which inflation comes down. And until we know that speed, we can't necessarily call the reflation or the recession in tandem yet.
Exactly.
But yeah, okay, so defensive it is. That remains the same call. I don't see any other reason in any of the indicators that I'm looking at or even in my model that tell me to throw on my risk hat and run back out to the marketplace.
Yeah.
Anything else you want to add there?
I'm on the same page as we speak today. It's the 21st, and there's been a good decline in risk assets. I guess I would just say that this is probably not a dip that I would be buying given my outlook.
Yeah. No, well said. Well, I definitely want to appreciate all the listeners. Eric, as always, I want to give you a chance to plug how people can find you and how to get a hold of you as we close out here.
Yeah, thanks, Grant, and thank you for always leading these conversations. I would do a terrible job if I was given the the quarterback role. So
I highly doubt
it's
it.
it's good that it's in your hands. But if anybody wants to find my work, you can go to epbmacroresearch.com, or you can find me on Twitter at EPB Research, or just send me an email, eric@epbmacroresearch.com.
Perfect. He's Eric. I'm Grant. Thank you all for listening. We'll be back again with another quarterly outlook at the next quarter.